Hello and welcome to another financial analysis video with Moeed Amin and Ted Wayman. Today we're going to be looking at BT, was British, well, it used to be known as British Telecom in full. So the purpose for these shows is we help you build your business acumen by helping you understand the language of business, which is finance. And we do that by analyzing the financial statements of famous and well-known brands. So just a quick note about BT before we dive into the financial analysis. So BT essentially founded in 1846. Interestingly, it was the first public telegraph business in the world. And they currently operate in, I think it's 180 countries. And they're basically a telecoms business, and they operate in things like broadband, TV, mobile. In fact, they are the largest mobile provider in the UK, after they acquired a company called Everything Everywhere, which was a merger between T-Telecom and Orange. So they are a pretty sizable business. They also, along with one other company, Virgin Media, they are the wholesalers almost of the infrastructure. So they build the infrastructure, the ADSL networks, the fiber networks, etc. And then other service providers will probably pay them a fee in order to use their lines for their own services. But essentially, BT and Virgin Media are the two big players who actually build the infrastructure under the roads in the UK. Now, we're going to look into both the financial statements so that you can analyze those better, and we're going to look at the share price. But before we do so, this video was a recommendation from one of our viewers. And 98% of the videos that we post out here and the companies we look at are from our viewers. And I'll show you, stick towards the end, because at the end of the video, I'll tell you exactly how you can do that. Two requests from Mungo and one from Mano SP3. So with a bit of context there, which Ted will go into actually as he's doing the analysis, but thank you for your request there. Quick note on the share price, and stick around again towards the end, because we're going to look at the share price in more detail just to see, what correlations might be there in relation to the financial statement. So if you'd invested in 1984 when they IPO'd, you'd be sitting on an increase of 41%. If you invested 5 years ago, that would be 49% decline. And if you invested a year ago, you'd be sitting on a decline of 25%. So certainly a bit of a rocky road there. So without further ado, let's hand over to Ted and let's share with you how you can analyze a statement of a company like BT or any of the other telecoms businesses as well.
Thank you very much, Moeed. Welcome back to all of our subscribers. Welcome if you are a new viewer. And as Moeed said, we are going to have a look at the financials. And this is the annual report and accounts. It's for the year ended 2022. Now, we're recording this in November 2022, so the year end won't be December. It actually is the end of March 2022, as we will see in a minute. These annual report and accounts are available on their website, and this will give you lots of information about the company, who they are, what they do, who's in charge, their pedigree, what their strategy is, what are their key financial indicators, key performance indicators, the corporate governance, etc., etc., etc. But we are going to scroll all the way through that, and we're going to focus on the actual financial performance, the numbers that sit behind the business, and we can find those here. They are that's the previous year, so here they are on page 131 of this report. So we are looking at the kind of the total numbers. Here they are. So revenue for this company is 28,850,000. It's in millions. So we're looking at just shy of 21 billion pounds. That's their revenue or their sales, 21 billion pounds. A little bit down. So you can see the previous year, you have to scroll down for the comparative numbers. It was just over 21 billion. So that's about a 2% decline. Which is, well, no company likes to see a kind of a fall in revenue, but it's not significant. No cost of sales for these guys. So as Moeed mentioned, these guys are a network operator. So they kind of sell a service. They sell space on their network, basically, and they have to maintain that network. And this 18 billion here is the cost of maintaining the network, giving them a profit of just under 3 billion. You'll notice that they have a finance expense, and this was the comment from our subscriber who asked, do they have too much debt? Is this a problem? And regular viewers will know that we like to just kind of compare the interest payable to the operating profit to make sure that they can afford that. So if they're making 3 billion in profit and they're paying 1 billion in interest, they can afford it. It's a lot, they can afford it, but of course interest rates are starting to tick up at the moment in response to the inflationary environment. Is that going to be a problem? But then maybe you can argue that they can push their revenue up because it will be linked to inflation. So it looks to me like they're okay. They can cover their debt, and it doesn't look like a big warning sign at the moment. So 3 billion profit, 1 billion in interest, leaving them with 2 billion, and then they have to pay some tax, leaving them with 1.3 billion for the shareholders. And here we can see the earnings per share. So if you own one of these shares in BT, then of that 2.3 billion, just under 13p is yours. So there's obviously quite a lot of shares, and that is a small decline on the previous year's earnings per share. So there's BT, that 1.3 billion. This is about a 6% gross, net margin. The 6% net margin, it's actually pretty low. I do some work in the telecom sector, and the sort of the benchmarking, that is pretty low. So if you head off to, I don't know, Saudi Telecom, for example, they're operating at a 20% net margin. So that is quite a low figure, and I don't know whether that's a kind of just a reflection of the fact that this is a high figure and that it's a high cost of running this operation, certainly here in the UK, for example, although of course BT are all over the world. Let's have a look at their balance sheet. Here it comes, their balance sheet. So you can see they've got the comparative on the right hand side, but we're looking at the left hand side, 2022. Biggest number. So the intangible assets, now this will be a very big number. There'll be some goodwill in there. We can have a look at note 13, but a lot of that will be licenses. So intangible assets, for those of you who aren't familiar with the term, things you can't touch, like patents and software. And for telecoms, it's going to be a license. So they're going to buy a 5G license. They buy it from the UK government. They pay a lot of money for it. And that license, you can't touch. So it's an intangible. They've also got a lot of property, plant and equipment, which is, all sort of the networks and switches and cables and phone masts and all the stuff that they need. And then some of that equipment they don't own. They've got it kind of on hire purchase, so to speak. And that's really, the three big numbers that are driving their non-current assets. So very, very capital intensive business here. Current assets are 9 billion. Trade and other receivables. They've got some contract assets. They've got a few investments, which is quite interesting. So that investment, we really kind of just, basically that's the sales cash. So for somebody like BT, that's not investing in kind of long term. That's kind of places where they're parking cash. So when we look at how much cash they have, we really want to be looking at these two numbers together and showing that they've got over 3 billion in cash, a little bit down from the previous year when they had over 4.6 billion in cash. Further down the line, we've got the current assets and the current liabilities and the non-current liabilities. Little comparison here. So just look at the current assets and the current liabilities. Those of you who are familiar or who are regular viewers will know that this is known as the current ratio. Current assets, things that we own, we're trying to turn into cash. Current liabilities, things we have to pay soon. Anything below 1 is usually a warning sign. However, telecom companies can operate. So telecom companies usually operate at below 1 because they don't need so much working capital because of their business model, because they get a lot of money up front. So BT will have SIM cards, for example. You think about EE, they'll have a lot of prepay customers, and those customers are paying them in advance of getting the service. And that gives these guys very, very strong cash flows, a little bit like supermarkets who get paid by their customers before they have to pay the farmers and the suppliers, for example. And the biggest number in their current liabilities is their suppliers. And the biggest number in their non-current liabilities by far is the debt. And obviously that debt is then driving. There's a little bit of debt you'll notice here. That's not really a problem. We can take those two numbers together as the debt. And that debt figure together is driving the interest that they are paying. So, if we look at that debt, for example, their cost of interest looks to be about 6%, looks high, but not unreasonable, so to speak. And all I've done there is just divided the finance cost by those two debt figures added together. So quite a lot of debt. That 873 here, this is what they have to, the debt they have to give back very soon. What BT is probably going to do is to go into the market and refinance that. So they're going to borrow the money to repay the money, and we'll be able to see if they're doing that by looking at the cash flow statement. But you'll notice that these numbers are relatively stable year on year, so it doesn't look like there's a big kind of debt, a debt repurchase or a debt pay down program going on. What else have we got in the non-current liabilities? Lease liabilities. So these lease liabilities here, again with the just make sure I get the right line. So these lease liabilities here in the current and the non-current section, those are related to the right of use assets that we were looking at in the balance sheet, in the assets. And then they've got a few other bits and pieces. Interesting enough, this retirement benefit obligations, you can see that that's a big shift coming down. Now, this has been a bit of an issue. So this is the pension scheme for BT, and in effect, what's happened is that in previous years, as interest rates have come down, the liability has gone up because the pension scheme is no longer expected to grow as rapidly, and now interest rates are coming up. It looks like that pension scheme, the liability is coming down to a much more manageable 1 billion. It actually caused, I think it was back in about 2010, BT's balance sheet went negative as a result of their pension scheme. Okay, and that's by the way, that's a pension scheme sits separate to BT. So the employee BT scheme is separate to BT. It has to be separate ever since Maxwell went for a swim. The kind of authority said, no, you've got to be separate. But this is the extent to which we think, or the authorities think, that pension scheme is underfunded. And if there is an underfunding, then BT has to pick up the difference. And that's what this number here is. So if we add all the assets and deduct the liabilities, we get to the equity. And this is the kind of the bit that's left over, the 15 billion, which is funding the business, and it is being funded really by this retained earnings. So there's a big retained earnings number coming through there, and these two numbers up here are the investment by the shareholders. So, looking pretty positive. There's no kind of, no massive gremlins there. Non-current liabilities, 25 billion. Shareholders funds, 15 billion. So it's kind of a little bit more debt than equity. But I don't think that's an issue. It's an infrastructure company. The debt secured on the will be secured on the assets. So there's no kind of major issues there. So the balance sheet looks pretty reasonable. Not massively strong, but not massively weak either. This is their retained the sort of movement in equity, just to see what they're doing with their profit figure. So you remember during the year they made that 1.3 billion of profit. There it is. And they made a little bit of other comprehensive income. So that other comprehensive income, it's quite a big number here. That's a profit that they've made, which they're not allowed to show as in the profit and loss account because they can't recognize it. And that will probably be the movement on that valuation in the pension scheme. So it's like, we thought we were going to have to pay 5 billion last year. Now we only think we're going to have to pay 2 billion. Therefore, we've made a saving of 3 billion, but it's not an actual profit. And so this is what we call kind of, unrecognized gain or income. And that's what's driving that number there. Dividends, so they're going to pay out some dividends. That's good. So there's dividends, and there's there are any share buybacks. I can't see any share buybacks going on. So no, that's kind of mainly. There's a little bit of buying back of own shares, 65 million and a little bit of dividends, and not a massive amount of dividends, and therefore you can see this retained earnings has dramatically increased. And again, maybe that's kind of company just just shoring up and sort of strengthening its balance sheet. Okay, if you look at the previous year, non-current liabilities 30 billion, equity about 12 billion. This year, non-current liabilities have fallen from 30 to 25, and the equity has risen from 12 to 15. So that's a kind of just shoring up the balance sheet, strengthening it a little bit, and making the company a little bit stronger, so to speak. Here's the cash flow, and as I mentioned, very, very strong cash flow as we'd expect. So the cash flow for these guys is generally higher than the profit, because they are they are generating a lot of cash, and a lot of that profit will be in depreciation. So they've got lots of assets. Those assets therefore are being depreciated. Depreciated is a non-cash expense, and that means that and there you can see the depreciation adjustment coming through. And so when you take the profit, add back the depreciation, you end up with this very, very strong cash flow, very similar to their EBITDA. What are they doing with that cash? Well, again, we need to be careful about what's going on here. So these numbers here, this is just buying and selling investments. So the way to read that is that, oh, I've got some spare cash, I'll put it in my deposit account. Oh, I need some spare cash, I take it out. Because of IFRS rules, they have to account for it as an investment. It's not really investment. This is the investment here. So this is the number we're really interested in. And they are investing 5 billion, nearly 5 billion a year, means that there's strong investment going on within BT. We might just then compare those numbers with the depreciation. So if you're depreciating your existing assets are about 4.4 and you're investing 4.6, it means there's a net growth going on there. Not massive, but there is this form of growth, and so that's looking pretty healthy. And in terms of the financing activities, so they're paying dividends, they're paying some interest, they're repaying the loan and borrowing money. So the difference between these two numbers is the kind of the refinance, or these two numbers together is the refinancing. There's a little bit of debt reduction going on, and again, I think that's probably just BT just trying to strengthen the balance sheet, increase the equity, reduce the debt, reduce their exposure to raising of interest rates, etc., etc., etc. So net cash outflow from investing activity, also from financing activities, 2.5. And so overall, they're seeing a drop in their cash. Now, don't worry too much about that. This isn't a major issue because they've got a lot of cash on the balance sheet. Now, when they say they've got closing cash equivalents of about 700 million, as we saw, a lot of their, or most of their cash is just sitting in these investments, which is where they've parked their spare cash. So when you want to look at a company like this and say, how much cash have they got? As we said, we need to be taking these two numbers together, not just the 777. So they've got lots and lots of cash, and that's a pretty strong balance sheet from my perspective. So they are those are the key numbers. A lot of debt. They are paying interest, but it's not a massive issue. Liquidity certainly isn't an issue for these guys. There's some good returns coming through. The return on capital, for example, I think we can calculate it at about my return at 18%, for example. So on an EBITDA basis, return on capital at 18% is looking, very, very strong. They can easily pay, service their debt. I guess, the cash flow isn't an issue. So, if we go and have a look at their share price and see what the sort of the valuation is looking like, we see, well, here we have ever since they kind of floated, and you'll notice you can spot the dot-com bubble here. So this was the year 2000, the TMT bubble as it was known, which was technology, media and telco, and they've never, so if you bought here, you're still sitting on a significant loss, but we're kind of much more interested in kind of slightly more recent performance. So if we scroll forward, and this is a 5-year look at the company, it's been bouncing around a bit, as you said, Moeed, depending on when you make your investment, you may have made money or lost money. It has been losing money. It's kind of been tracking sideways and then falling. And it's now on a market cap of 12 billion. Well, just to remind you, Moeed, when we looked at the balance sheet, Okay, if you look at where the arrow is pointing now, that's the equity, which is 15 billion. Okay, so in theory, if you take all of the assets of this company and turn them into cash and then pay off the liabilities, and you can't, I mean, I'm talking very theoretically, it'd take a long time to be able to do that. But in theory, if you did that, you'd end up with 15 billion. Okay, so what this is saying is that, you know, you can buy a company today for 12 billion, which you could effectively just break up and sell for 15 billion, and that would bank you 3 billion. So these guys are trading at below net book value. That's kind of negative goodwill, so to speak. Price to earnings ratio of 7.2 times earnings. Okay, so on my calculation, I'm on about 9.6 times earnings. It's about the same sort of ballpark, but you know, that's a really low price, low P ratio, suggesting, you know, very high yield. You know, that's over 10% yield. The dividend yield they've got up at 6.2%. My dividend yield I've calculated is a little bit lower than that, so I'm not sure whether maybe they've got an interim dividend that has come out through that. But you know, it's just cheap. So these guys are cheap. Now, I guess part of the question was, you know, does that make them a buy? The answer is I don't know. I'm not familiar with BT. You know, is it part of a long-term trend? Is it a company that is just you know, gonna go on a long-term decline? I can't really see it is. You know, as you said, they own the infrastructure, they own the kind of the last mile. You know, we're always going to be using, you know, telco in some form. They are, you know, they are at the cutting edge. They're investing in, you know, 5G and, you know, as Kevin Bacon keeps telling me, for EE and all that kind of stuff. So, you know, it's a really difficult call for this. I mean, this may be, you know, this may be something where you kind of, you know, you take a little bit on a well diversified portfolio and hold it for a long term, and hope that the value will come back. It just, you know, it is definitely cheap. Maybe it's cheap for a reason, but I can't think as to why you would be, you know, sort of nervous about this company. Just a last comment before we finish. We'll just have a look at our CEO. So if we can have a look at page 104, we'll find our CEO's remuneration. So here is Philip Jensen, and Philip Jensen is being paid a total, you will see here, of about just under £3.5 million, which is, I don't know, probably pretty reasonable for a seat. Well, I don't know if it's reasonable. I'm not sure anyone's ever really worth £3.5 million. I'm sure he works very hard indeed, but I'm sure there's a lot of other engineers and people at BT who are working very hard as well. Anyway, he obviously, somebody reckons he's worth 3.5 million pounds. And if we look at page 146, if you work at BT and you're interested, which some people sometimes are, if you look at page 146, it will tell you your operating costs, and there you can see the kind of the cost of the staff. Interesting enough, it gives you this little note, this own work capitalized. So this number here is basically staff, and you're working on a piece of software, and that software is going to give me benefit in the future, then I can capitalize that software. So that's what that number there is. But we're interested in this total staff costs, which are 4.8 billion, so 4,845 million pounds, so about 4.9 billion. And if we look on page 147, here it is, it'll tell us how many people are employed. And the answer, yeah, here we go. So this is the number I'm looking for. So the average number of employees during the year is about 99,000. And so if you pay 99,000 people 4.8 billion, they get about 49,000 pounds each. So the average employee at BT is earning 49,000. So if you work at BT, you can work out whether you are above average or below average, and you also can probably work out that the CEO, the big boss, is paid 71 times the average salary. That's not the most expensive we've seen. It's not the cheapest we've seen, but 71 times is quite a lot in my book. So there you go, Moeed. That's my analysis for you. I hope you found that useful and informative and interesting. We go back to the, we're not giving investment advice here, but what we are trying to do is to teach the language of business finance. And I hope that if you work at BT, that helps you understand the financial drivers of your business in a little bit more detail.
Yeah. So whether you are interested in this company because you're selling services to them, or whether you're thinking about investing in the business, or even as we've done, as Ted has just shown in the last part, if you are up for an interview with this company and you want to look smart and get that job, then this video has been useful for you. And especially for any future investment, for any future statements like quarterly statements, half-year statements, etc., referring back to this video will help you analyze those statements a lot faster and with more confidence. So I promise to show you how you can submit your request for any company that you are interested in. And actually, it's a very simple way of doing so. So in any one of our videos, if you leave a note in the comments section, tell us the name of the company you're interested in, and give us some context as to why you're interested in this company. The more interesting that information, the higher likelihood you'll be prioritized and your video will be published sooner. So do leave a note in the comment section for any of those videos. Don't forget to like and subscribe. As a subscriber, hit the notification button so that you get notification of all the new videos. And if you know people who are interested in BT or any of the companies that we've analyzed, do please share the video with them because we invite their comments as well. We like to learn from each other. This is an education show at the end of the day. So until the next video, thank you, Ted. Thank you, everyone. We'll see you in the next one.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.